Hey, everybody, it's Brad Sumrock, and I am live here at my kitchen table. And yes, that's the back of my head. There's a mirror behind me. So, hey, it's good to see all of you. If you want to type into the chat, we have it set up here so that as a host and a panelist, I can see everybody's chat. So I'd love to know where you are all dialing in from tonight. So hello, Poosproop. Hello, Joyce. It's good to see you. So we have Connie from Del Mar, California, Joyce from Montana. Hi, Sharon from Richardson, Texas. Jessica from Oxford, Michigan. Is that Michigan? I believe so. Brampton, Ontario. Plano, Texas. Hey, Andrew, good to see you. Michael from Sacramento. We see Jacob from Sacramento, Cody, Wyoming, Randall, Illinois, Houston, Indiana, Dallas, Texas, Toronto, Detroit, New York City. I was just there in New York City, Bowling Green, Kentucky. Yeah. So you all should be able to see me, by the way. My camera's on and you should be able to see me. So people from all over the country here. David from Plano, Bill from Phoenix, Arizona. Too many for me to read and keep up with. So if I missed you, I see Bernadette. Let's see, Massachusetts. Yeah. Well, hey, I'm going to talk about one of my favorite subjects tonight, and it's taxes. But it's not paying taxes, it's reducing how much tax you pay. So I have a question for you. Calvinita is hearing an echo. How is the sound quality for everybody else? If it's good, just type in good. Is the sound quality good? Okay, well, I'm hearing good, good, fine. Anybody else? Good, 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 good. Okay, well, Calvinita, I'm sorry. It might be on your end because everybody else in here is typing in good or fine. So maybe there's something you could do there on your end. Maybe you're logged in a different way. I'm not sure. So you're welcome, Calvinita. Hey, I care about your experience. So, okay, look, so I want to start by telling you that when I got involved in real estate, I had a real estate mentor. Many of you know that. Many of you know how that's I started is I read Robert Kiyosaki's books. I went to a real estate investing seminar because I had absolutely no experience. And they did a $500 2-day seminar. And then they had a 5-figure mentoring and coaching program. And I bought it. I didn't think I was going there to buy anything. But at the end of the 2 days, it made sense to me. So I bought it and I followed the steps. And many of you know my first deal was a 32-unit building. I bought with my own money. I had no experience. Then I bought another 30 units with my own money. And so I have 62 units and now I'm out of money. And that forced me to learn the capital raising and syndication business. And so my third deal was 250 units that I bought with other people's money. So that's kind of how I started with reading Rich Dad, Poor Dad, going to seminars, having a coach, a real estate mentor. And I remember my mentor told me, he said, Brad, there's 4 types of millionaires, 4 types. Okay, get this. He said, number 1 is when your net worth reaches $1 million. So that's a million of net worth on paper. Okay, your assets minus your liabilities is $1 million. They could be illiquid or liquid, but you're technically a net worth millionaire. He said that's the first type. The second type is when you have $1 million liquid. Okay, so that means like you have $1 million that you could, it's not home equity, it's not your car or your furniture, you know, it's like liquid assets that you could hopefully invest and that generates a return. You know, so if you can invest $1 million and get, say, an 8% or 10% return, now you have 80, 100,000 coming in every year. That's the second type of millionaire. The third type, he said, is you make $1 million a year. And so as I progressed through my career, you know, I checked the first box, I checked the second box, and I checked the third box. And then he told me, and this was in the very beginning, he said, Brad, someday you'll achieve the fourth type of millionaire. And I said, what's that? And he goes, you'll pay $1 million in tax. So I just thought, oh boy, like, hey, look, to pay $1 million in tax, you got to be making what, 3-4 million a year, right? Because our tax system is incremental. When you hear about our tax bracket, our top tax bracket being 37%, or it used to be 40%, that's not on all your income, it's incremental. And after a certain income threshold, and I can't remember what it is, but it's several $100,000, then after that, everything is taxed at your top bracket. And so to pay $1 million in tax, you have to be making 3 or 4 million a year of taxable income. So let's fast forward to 2017, which was 9 years ago. And in that year, I paid $965,000 in tax. And I remember I was speaking, I do a lot of events, seminars like this one, but I do in-person events. And some of you are coming to my next event, by the way, and I'll talk about that tonight. But I speak at other people's events as well. So I was speaking at, my friend Robert Helms runs an event called The Secrets of Successful Syndication. And some of you have been to his events. He's a good friend of mine. So I'm speaking at his event, and I'm telling this story of the 4 types of millionaires and how that year I just wrote out a check for $965,000. And I was kind of proud of it. Like, seriously, I was like, man, I'm almost there. My first real estate mentor in 2002 told me these 4 types of millionaires, and for 15 years. And so in the back of the room is a guy named Tom Wilwright. Many of you know him. Many of you met him at my events and my masterminds because, long story short, is Tom has been my personal accountant and CPA and tax strategist for 9 years, like since 2017. So Tom heard me speaking, and when I was done, he came up to me and he goes, Brad, I don't ever want to hear you say that again. And I said, what? And he was like, you shouldn't pay $1 million in tax. You shouldn't have a goal to pay $1 million in tax. He goes, in fact, I have clients that make more money than you that pay less tax. And so I hired Tom. Okay. And he goes, oh, I don't just do tax returns. He goes, I charge $50,000 just to take you on as a client. And I do strategy, which means like, I look at all your businesses, I look at all your tax returns, and then I meet with you proactively throughout the year, like every quarter or every other month. And I give you recommendations on what to do during the year so that when the end of the year comes, you can minimize your tax you're paying, no matter how much money you're making. So I hired him the first year, and within 6 weeks, he saved me $150,000. And by the next year, that $965,000 literally went to zero. Okay. So now, since I've been working with Tom for going on 9 years, I've paid 0 federal income tax 6 out of the last 8 tax years. So as you know, we are just finishing now the 2025 tax year in 2026 because taxes are done in arrears. So I can't teach you accounting and taxes like a CPA can, but I can tell you about it from my direct experience. And so what I want to talk about tonight, you see the topic is how to reduce your taxes by investing in apartments. So are you guys ready? If you're ready, type in yes, and we're going to get started. So let's go. Okay. Calvinita is ready. All righty. So let's go. So I'm going to share my slides here. I don't know if it's Crystalie or Ivy, whoever's supporting me, make sure I could share my screen. Okay, we got it here. So, by the way, in Miami right now, it was sunny all day, and I'm on the 17th floor, and I can't even see out of my balcony. There's a humongous thunderstorm happening right now. So what I want to share with you over the next 45 minutes, because I will be done at the top of the hour, is how I started and scaled. And I already shared a little bit about that. You know, read Rich Dad Poor Dad, went to a seminar, hired a mentor, bought deals with my own money until I ran out of money, and then figured out how to syndicate. Okay. So how did I start? How did I scale? And then I want to cover briefly how we make money and save money by investing in apartments. And so I'm briefly going to talk about cash flow, appreciation, and tax savings. And then I'm going to dive into exactly how taxes work. And I'm going to show you step by step how it works. And then I want to share with you how you might be able to qualify to save money on and pay less tax. And the idea is to buy assets that cash flow, go up in value, and reduce your taxes. So when we talk about the apartment investing ROI, that's what it is. It's cash flow, go up in value, and reduce your taxes. And none of those things are guaranteed. But what is guaranteed is if you invest in an apartment deal, you will get depreciation losses this year, whether it cash flows or not, whether it goes up in value or not, whether there's a market cycle or not. The thing that's the most guaranteed in the year you buy the deal is you're going to get a loss allocated to you. And then whether or not you can use that loss to offset your income is another story. Okay. So the first thing I'm going to do is I'm going to talk about how these losses are derived. Because everybody that invests in apartments will get a loss allocated to them without question. Okay, that's not the question. The question is, can you qualify for immediate savings, or is it going to be deferred to some point in the future? Okay, so this is what I'm going to talk about tonight. And I'm going to share with you exactly how I went from paying almost $1 million a year to I don't think I've paid $1 million cumulatively in over 8 years in federal tax. And you're looking at the guy, and I'm not bragging, but I make, in a good year, more than 5 million of earned income. In a bad year, still 7 figures. Okay. So I figured out how to invest in buildings and pay no tax. So this is what we're going to talk about. So for those of you that are brand new, a little bit about me. I started with no experience, went to a seminar, hired a coach, bought 32 units, bought 30 units, ran out of money. Since then, I've done over 11,000 units, 67 apartment buildings, over 1.2 billion in purchase value. Well, that's not actually accurate. Paid zero in taxes since 2018. Now it's zero in 6 out of the last 8 years. I started coaching others in 2006. Okay, so my first client, the first person I helped quit their job was me. I started in 2001. I quit my job in 2005, and I became financially independent. And then I started coaching other people. And my students have made a big impact. They've bought hundreds and hundreds of apartment buildings all over the United States in many, many different markets. And if you add up the price of all the buildings they bought, it's over $10 billion. That's a lot. And literally over 1,000 of them have made over $1 million, or at least on paper, increased their net worth by over $1 million. So that's what I'm most proud of, is the impact I've made helping other people do what I do. So that's a picture of my 32 unit, my first deal. That's a picture of my 30 unit, my second deal. And these two properties put $7,000 to $8,000 a month in my pocket like clockwork. And then, as I already shared with you, I ran out of money, bought 250 units. I raised $2 million from 27 people. And I bought a 250 unit building, mostly with other people's money. That was my third deal. Okay. And then most of my deals after that have been syndications. So I'm going to, share that. For 10 years, it took me from 2002 to 2012 to get to over 1,000 units. Okay. And again, in a syndication, as a GP in a syndication, I don't own all 1,000 units. I have investors. So me and my investors had 1,000 units, and I have an ownership interest in these deals. That's what it means to be a general partner, to be the GP, like the active investor, the one who finds the deals, analyzes the deals, raises the money, secures the loan, manages the deal, manages the nuances, manages the management company. And I was the only active investor in these first 1,000 units. And I'm the active investor we call the GP, the general partner. Okay. And then in 2012, I wanted to launch this business that I'm now in, where I do events and coach other people. And so that became a passion of mine. And I started spending more and more time doing events and coaching other people. And I'm like, hey, how am I going to scale and still do apartments? And so what I did is I found a handful of other people on every deal where we split up the work. And so, the concept that I use is co-general partner, co-GP. And so from 2002 to 2012, I was the only GP in 1,000 units. And as a GP, we usually take 20% of the upside in the deal for doing all the work. So I'm taking 20% of the upside in 1,000 units. And then the next 10 years, maybe I have 3 partners. And so I'm taking a third of 20% because I have partners to split the work, but we're splitting how we get paid. And so I'm getting paid a third as much on every deal, but I was able to do 10 times more units. And that's how I've scaled massively. So in my mentoring programs and in my seminars, and it's not going to be my focus tonight, but what I teach people is how to form, these co-general partnership groups and go out and buy 60, 80, 100 units. And I'm a specialist at that. And I've helped thousands and thousands of people do that. Okay. So that's not the focus of what we're doing tonight, but that's a little bit of background about me. So my journey has been now almost 25 years, because I went to that very first seminar in August of 2001. So my real estate journey is almost 25 years. And I've done a lot of deals for myself and, 10 times more for my students, the people I coach, than I've done for myself. And in terms of money spent and time, it's been millions of dollars in me learning this business and figuring it out. And honestly, I'm still learning. Like, I know a lot and I'm an expert. I believe I'm the authority in multifamily investing, helping others get into the multifamily business. I believe I've done more of that than anybody else. Okay. And the thing is, I'm still learning. I'm still seeing things I never saw before. And I learn something new in the business every single day. Okay. So that's a little bit about me. And the company I formed, where we do events and create content, free, paid. We have paid communities, paid programs. I have a very big mission, and that's to change over 1 million people's lives, to impact and mentor over 1 million people, because financial freedom is possible by investing in real estate and by investing in apartment real estate. Like, I've done it for myself, and I've helped hundreds, if not thousands, of other people do it. And you want to follow a system. Okay. So this is not just a random chaotic process. There's a sequence of steps. There's an order in which things should be done to get the optimized outcome. And so I've done that and I teach that. Okay. So that's just a little bit about me. So going on to the topic at hand, and I already talked about the 3 ways we make money or increase wealth. Is one way, when we buy an apartment, it should cash flow. And cash flow is usually 5 to 10% cash on cash return. Okay. And we need cash flow because the way I quit my job, and in my job, I was making $10,000 a month, and then I'm paying 30% tax. So I'm bringing home $7,000. And after 62 units, I'm making $8,000, but I'm not paying any tax. Does that make sense? And I'm going to show you how I didn't pay any tax on that $8,000. So I'm making 7,000 working for someone else. And after 30 and 32 units, I have 8,000 coming in from, collecting rent and paying expenses. And the difference is 8,000 a month. But then I'm not paying tax. And so by Rich Dad, Poor Dad's definition, I'm retired, because retirement is when your investment income meets or exceeds your earned income, and you can quit your job and now live life on your own terms. So I actually waited until I did the 250 unit syndication, and then I quit my job. So we get income from cash flow, from operations. So this is one way we make money. The second way is, over time, the value of deals go up. Now, I know that we're in a cycle right now, and there may be some people on here that bought in 2022 at the top of the market, and maybe some of these deals right now in this moment of time may be worth less. But I've been in the business since 2001. And if you just look at the trajectory, the value goes up over the long term. And it goes up from organic growth and forced appreciation. Forced appreciation is when we buy a deal with meat on the bone, like, a deal that maybe needs some upgrading or needs better management, or needs more attention. And so, because the income of the property determines the value. In multifamily, the more rent you collect and the higher the occupancy, the value goes up. Okay, so if the income goes up, the value goes up. And so if we can find an underperforming deal, raise the rent, raise the income, optimize the expenses, it becomes more valuable. It cash flows more too, but it becomes more valuable. So I'm going to show you an example of a deal I bought for 13 million and sold for 19 million in 3 years. And that wasn't just because of organic 3% growth every year. It's because I bought an underperforming deal and made it perform better. And so I was able to massively increase the market value. So, so we buy deals to get them cash flowing and to increase the value, which increases our net worth. And the third reason we buy deals is because we don't want to pay tax legally. Okay. And the government has a very complicated tax code. But here's the secret. It's not complicated if you just have a W-2 job. It's very simple. You have a job, you get a paycheck, they deduct taxes out of your paycheck. At the end of the year, you reconcile, did you have enough taxes deducted or not? You could probably use TurboTax if that's still a thing, or have a simple tax, your tax return might be 5 pages, You have a standard deduction. Here's your income. Here's how much you owe. If you didn't have enough tax taken out, here's how much you get back. If you had too much tax taken out, it's simple if you have a job. The 600 or 700 page tax code is actually a code on how you can legally reduce your tax by investing in things the government wants you to invest in. So, I learned all this from Tom Wheelwright, by the way. So so when we have a president and a Congress that, let's say they really want to incentivize, electric cars, they give you tax credits to buy an electric car. They give you tax credits or tax incentives to invest in clean energy. When Trump and Kamala ran against each other, if Kamala won, she was going to continue tax incentives for clean energy, electric cars, and minority-owned businesses. When Trump won, he got rid of the incentives for electric cars. Like, they're all going away if they haven't already. And he started incentivizing people to invest in oil again, coal, oil, and housing. Okay, so our government decides what their platform is politically, like how are they going to, sell themselves to voters? What are they going to incentivize people to do with their money? And so this complicated tax code, that's really what it is. It's like, how do we use the tax code to pay less taxes? Okay. So again, it's not written for the the average employee that has one source of W-2 income. It's written for investors, entrepreneurs, business owners, small businesses that are hiring people, that are taking out loans, that are buying capital equipment, that are buying real estate, that are building housing, that are investing in existing housing, that are investing in oil and resources and things that our country needs. And so we have incentives. Okay. So what Rich Dad, Poor Dad teaches, if you ever read that book, by the way, if you read Rich Dad, Poor Dad, type in the chat, just type in Rich Dad. I want to see how many of you have actually read the book, Rich Dad, Poor Dad. So go ahead and type that in the chat. Rich Dad, Jessica read it, Michael read it, Richard read it, Shannon read it, Star read it, Randall read it, Dwayne read it, Sharon read it, Servando is still reading it. Look, I read it like 4 times, okay? So if you read the book, you know that E stands for employee, and this is the second book, The Cash Flow Quadrant. And employees at the top income level generally pay between 37 and 40% of their income to federal tax, not to mention state and local and sales tax. So when you add up state tax, local tax, city tax, sorry, I picked up a little bug in the back of my throat the last couple of days. It's going away. For those coming into Miami this weekend for my mastermind, I'm fine. Don't, but I have a little itch. If you're self-employed, meaning like you run a accounting company or a law firm, or you're a physician and you work for yourself and you don't get a paycheck. Now you're paying your same rate as a highly paid employee, but now you're paying your self-employment tax, because when you're an employee, your employer is paying tax as well for you. And so if employees, you don't pay that, the employer pays it. But if you're self-employed, you're paying the employee tax and the employer tax. So your tax rate is like 50 to 55%. And then on the right side of the cash flow quadrant, we have business owners and investors that generally pay between 0 to 20% of their income. So, Robert Kiyosaki is the best-selling author for personal finance of all time. He's not the best investor of all time, but he's the best communicator on breaking down, complex topics and making them simple. And that's why he's a very effective author. And so you want to be a business owner and investor. And by the way, this is why I love apartment buildings, because even on my first 32 unit, I bought a business. I had a manager, I had a maintenance person. It's not the same scale as 250 units when I could hire a management company and have all the accounting and bookkeeping done for me and all that. That's a real business. But even 32 units, even if you go out and buy a 10-unit building and you have a manager or a property management company, at some level, way, shape, or form, you have a business and you will pay lower tax. So even if you want to start with 10 units and buying your own small deal with your own money, which I taught 2 weeks ago, right here, same time, same place, same channel 2 weeks ago, you can watch the recording. I taught how to buy small apartments with your own money. So tonight, we're going to focus on the tax, okay? And again, cash flow is projected. Appreciation is projected. The year one tax is not projected. I mean, let me be accurate. When we buy the deal, we have an estimate of what the tax savings will be. And then once we buy the deal and we hire the company and we complete the study, now we know what it is. So even though there's an estimate, what I'm saying is when you invest in an apartment building, we're going to have projected cash flow in year one, and that may not occur. We're going to have projected appreciation in year one, and that may not occur. We're going to have projected tax savings in year one, and it will occur. Or let me be more accurate. The depreciation loss will occur, and you will get your pro rata share. That's guaranteed. Okay, it's guaranteed that you will, if you invest in a deal, you will get depreciation loss allocated to you in that calendar year. That's not a projection. It's going to happen. Again, the question is, can you use it this year? Does it, defer for future years? So let me talk to you about how this works. Okay. So everybody probably understands the concept of depreciation. You hear about, like, when you buy a car and you drive it off the lot, it goes down in value. So that's actually a depreciable asset. And just like cars, the government lets you do the same thing for residential real estate. And what they assume is if you buy a deal, say a 10 million, you have to allocate a certain portion to the land, and land is not depreciable. Okay. And so let's say in this example, you buy a $10 million property and 9 million is allocated to the improved value, which is the building and everything inside of it. And so what the government allows you to do is say every year this building is going to experience wear and tear, and go down in value, so to speak, on the books, the tax accounting books, by $327,000 a year. And so if you paid 10 million, it would theoretically have a $0 book value in 27 and a half years. And this is called straight line depreciation. Okay. Now, the reality is, some of you may be confused because some of you might have heard me say, hey, Brad, wait, I thought you said that we try to make it go up in value. I'm talking about market value. Okay. When we buy a deal and we raise the rent and we raise the occupancy and we occupy and we optimize the expenses, the market value goes up. Meaning we buy the deal for 10 million, and in 5 years, we're looking at selling it at, say, 15 million. But the value on our tax return shows that it's depreciating and experiencing wear and tear every year. So I want to make sure you understand that. The depreciated value is not the same as the market value. Okay. Totally different. So the government, again, lets us assume that these buildings have loss associated to wear and tear. And the thing is, when I buy the deal for 10 million and depreciate it, and someone else buys it later for 14 million, now the basis gets reset at 14 million, and then they get to start all over again and depreciate it as well. And it goes on and on and on. It doesn't matter if it's a brand new building or a building built in 1950. It's the same formula, 27 and a half years. And so how this works is, let's say this building cash flows at $360,000 a year. We would take the cash flow, which is income that's taxable, and then we subtract the depreciation from it. So we buy this building, it spits out $360,000 a year. Let's say we're all investors in the deal, so we're getting cash flow, but we have a very, very little taxable income, as you can see on the slide, because of the depreciation. Okay, so this is called straight line depreciation. And what I mean by that is it's the same amount every year for 27 and a half years until basically it's depreciated from 9 million all the way to zero. Okay, so that's straight line depreciation. And some people actually do it that way. Some accountants actually advise their clients to do it that way. My accountant, before I met Tom Wheelwright, advised me to do it that way, straight line. Okay, so let me check in here on yes, we will get a copy of the recording. It will be sent out after it processes, and it will be sent out in, say, 24 to 48 hours to everybody who registered. Okay, so you'll get this. So this is straight line depreciation. So we got to understand that. And I'm going to move on to the next topic. So the next topic is called cost segregation. So remember I said we paid 10 million for this building. and the improved value is 9 million. The improved value is the building and everything inside of it. So what is inside of an apartment building? Okay. Well, there's real estate, which is the real property. Now, not being a lawyer, it's hard for me to define real property, but you could go to GPT or Google and you could type in what is real property, REAL property, and it'll tell you what that is. But also inside an apartment building, there's personal property. So now I'm making the distinction between real property and personal property. And within personal property, some personal property depreciates in 5 years, and other personal property depreciates in 15 years. And then the real property still depreciates in 27.5 years. So the reason we call it cost segregation is we hire this engineering company. And here's the deal. When we're buying the deal and we're analyzing the deal, the company will give us an estimate of how much 5-year, 15-year, and 27.5-year property there is. But they can't come on site and do the full-blown study until we close the deal and now own it. And now we formally hire them. And now they go into every unit, every system, every infrastructure. And then they clearly identify all the 5-year, all the 15-year, and all the 27.5-year property, meaning like rather than having the whole building depreciate at the same rate over 27.5 years, now we find property that goes from full value to zero in 5 years. We find property that goes from from full value to zero in 15 years. And then the rest goes from full value to zero in 27.5 years. So the cost segregation company is dividing up the building and everything inside it into 3 categories. And what it does is 5-year and 15-year property get more depreciation faster, than 27.5 years. So the same example is we pay 10 million, we have an improved value of 9. Same deal gives you the same cash flow at 360,000. But now, because of cost segregation, we get almost about double. Okay, it's about double. Okay, and I've done, I've had 67 apartment buildings. I've done cost segregation on almost all of them. And so I've done it like 60 times. Okay, so it's not exactly double, but as a rule of thumb, it's about double. And so now we take the cash flow at 360 minus the 654. So now we have a net loss. And what happens to that net loss? Well, it gets allocated to the investors based on your capital contribution, your ownership percentage. Okay, so you can see we buy a deal, and this happens even if you close the deal December 31st and you do the cost segregation study the following year, which if you close the deal December 31st, you wouldn't do the cost segregation study until January or February. We won't even have the results back until February or March, but you will still get your pro rata share of depreciation loss allocated to you. Like that's guaranteed 100%. Okay. So you get the net loss. And then what happened in 2017 is that the first Trump administration and the Congress that was controlled by the Republican Party passed the 2017 Tax Cut and Jobs Act. And what that did is it took all of the 5 and 15-year property that's identified in the cost segregation study, and it allowed you to take 100% of it in year 1. Okay, so rather than having the 5-year property depreciate over 5 years, you could accelerate it and take it in year 1, and the same with the 15-year property. And they put this law into place in 2018 because they really wanted to incentivize the American people to invest in housing. Okay, because we had a crisis and we didn't have enough housing. And so this is one of the things that really stimulated people like us to put more money into new development and existing buildings. Okay. And so it was scheduled to be in place for 5 years, 2018, 19, 20, 21, 22. And then it was going to be phasing out. Okay. So it was going to go back to zero after 2026. And then when Trump won again in 2024, and we had a Republican controlled Congress with the House and the Senate, they passed this bill that some people refer to as the Big Beautiful Bill, and other people refer to it as the Big Ugly Bill, depending on where you're at politically. But what it is that we brought back bonus depreciation, and this time it's permanent. So this time it's not scheduled to go away. Now, obviously, at some point in the future, we could have, a Democratic controlled House and Senate and a Democratic president. And if they would get enough votes, even though this is permanent, they could possibly get enough votes to change it. Like, that's how our government works. But the point is, it's when it was put into place in July of 2025, it wasn't a 5-year, it's a permanent bill unless some politicians in the future change it. So again, a $360,000 cash flow where it would have, $327,000 doing straight line depreciation, $654,000 doing cost segregation, and then doing the cost segregation and then accelerating depreciation in year one is going to give you a massive, massive loss in the year you buy the property. Okay, massive loss. So I'll never forget, like, I was in Grant Cardone's office and I was explaining this to him, and he's like, Brad, this is in 2020, by the way. He's like, Brad, that's not how it works. And he goes, and besides, if you close the deal December 15th, you only get 16 days of depreciation. And I said, Grant, that's not true. Like I know this stuff like the back of my hand. So he checked with his treasurer and CFO, and they said, Brad's right. And he's like, holy shit, this is amazing. So in the middle of our meeting, his social media guy comes in, and I'm in there meeting with him, and he puts me aside, and he's like, hey, this is Grant Cardone. It's, December 15th, and we got 16 days left. And if you invest in Cardone Capital by the end of the year, you're going to reduce your taxes. And I'm sitting there going, what the hell's going on? Like, I'm in a meeting with him, and this is actually, I paid him for coaching, and I'm in a coaching session with him where I'm paying him money, and he's doing a video on, what we were just talking about. So this is real. Like, this works. Tom Wheelwright taught me this. Robert Kiyosaki talks about this. So, the rich invest in assets that cash flow, that go up in value and reduce your taxes. The middle class, they're convinced to invest in stocks and bonds and IRAs and 401ks. And now, there was the NFT craziness and Bitcoin and all that. Like, these asset classes, even gold and silver, these asset classes, you only make money one way. There's no cash flow. There's no tax savings. There's no depreciation. And the only way you make money is if you buy low and sell high. And with apartments, we make money. We want to do that too. And we want to understand market cycles. I also just did a training not so long ago, maybe 3 or 4 weeks ago, on market cycles and knowing when to wait and when to strike. And I taught that, and I'll teach that again for those that come to my next training event in person. But the bottom line is, this is how the rich people don't pay tax. Okay. And the Democrats are doing it too. Like Nancy Pelosi, this lady's worth hundreds of millions of dollars, mainly because she's a business owner and investor. Okay. So the Democrats are not opposed to depreciation either. It's like the Republicans like it better, but the Democrats like it too. The cost segregation and depreciation have existed, George Bush, Obama, Biden, Trump. It's been around. It's not going away. Okay. They all own real estate. Okay. And their families and their trusts. So this is a picture of the bonus depreciation was scheduled to phase out. And then this big, beautiful bill that was passed in 2025 brought it back 100%. And it's not just 2029, it's permanent. Okay. So I've been going around the country for the past year talking about this, talking about how our government wants us to invest in housing again. And they're giving us tremendous tax advantages to do so. Okay. So now that we know how it works, how do you know if you could benefit from it in the year you invest? So here's what, and again, I'm not an accountant, I'm not an attorney. I can't give you tax or legal advice. I'm explaining it to you in the best language that I know how, that's going to come out in this moment of time based on my experience. That's my disclaimer. Okay. So every investor gets a Schedule K-1. You know, we put our money together, we buy a deal, you know, we hire an accountant that does the tax return for the entity that owns the apartment building. And then everyone that invests in the deal gets their personal schedule that says, hey, you invested $100,000 in the deal, and here's your allocated income, here's your allocated expenses, and here's your allocated depreciation loss. Okay. So everyone gets that. And if we do cost segregation and bonus depreciation, you will have a loss. So like if you invest $100,000 in a deal like this year in 2026, you'll probably, if you invest $100,000 in a deal in 2026, you will probably have on your K-1 a net loss of anywhere between $60,000 and $80,000. I'll say that again. If you invest $100,000 in a deal in 2026, you will experience a depreciation loss of around $60,000 to $80,000. Okay, which is humongous. So now whether you can benefit from this year or not depends on your individual situation. So the rule is depreciation is passive loss. And since it's passive loss, it could offset passive income. So now the question is, how much passive income do you have? Or, you know, so if you're an employee with W-2, that's all earned income. So if you're an employee and have W-2 income and you invest in apartment buildings and you get this depreciation loss, your depreciation loss is not going to offset your W-2 income, because W-2 income is earned income and depreciation loss is passive loss. But if you're an entrepreneur, a business owner, an accountant, an attorney, you know, a restaurant owner, I don't know, and you have a good accountant, they could look at your business and say, well, okay, Joe, you know, I'm just picking the name Joe. Hey, Joe Smith, like part of your business that you own, the business is generated passively, and the other part is generated through you actively. And so if you have a good accountant and you're an entrepreneur or a business owner, they may be able to look at your business and say, hey, some of your current income is passive income. Okay. And so you want to have that. You want to have a good accountant. Any of you business owners, investors, you know, small business owners, you may be able to do this. Okay. And the other category is if you're a qualified real estate professional on your tax return, and has nothing to do with licensing or education or being a realtor. It depends on, there's a status when you file your tax return called REPS, real estate professional. Okay, status. And in a nutshell, to be a real estate professional, you have to have documentation that you that you work 750 hours a year in real estate, which is about 15 hours a week, which is around, you know, less than 2 hours a day on average. And so if you're like a full-time realtor or a full-time appraiser or a full-time lender, or a full-time investor, then you're probably a real estate professional. And I'm saying probably because I don't know if you work 750 hours. But if you do it part-time and you have another job or another business, then the second part kicks in. So above and beyond 750 hours, at least 50% of your work has to be real estate related. Okay, so like let's say I have a full-time job as an engineer, and I'm I'm a real estate investor. And I say, hey, I do 750 hours of real estate. Well, the IRS would also say, yeah, but you're a full-time engineer. You do 2,000 hours a year of real estate. So you're not a real estate professional. You're a real estate part-time. Okay. So how I experience this is obviously I'm a real estate professional. So I get real estate professional status. A lot of married couples, they have one spouse do the 750 hours a year of real estate and nothing else. And then maybe the other spouse has a job as an engineer, attorney, doctor, lawyer, accountant, whatever. So in my coaching experience where I mentor people, I have a lot of couples where one of them is doing real estate and the other is doing their earned income. And so because they file a joint tax return, they get real estate professional status. So like I've literally had couples coming in that are making 5, 6, 7, 800,000 a year as doctors, attorneys, lawyers, dentists. And one of them does real estate and the other one continues in that field, and they're investing in apartments and making 800,000 a year in their job, and they're not paying any tax. Like, it's beautiful. Okay. It's beautiful. Tom Wheelwright, he's not a real estate professional. He's an accountant. But he told me that the way he has his business structured, his accounting practice, is that a lot of his income is passive. And so he invests in apartments and he's able to take depreciation loss and offset part of his business income that has passive income, which, he would need to, your accountant would need to explain that to you. So the bottom line is you need to have a really good tax professional help you with this. But so many people out there are finding that with good tax advice, a good accounting advice, they can invest in apartments and not only get the cash flow and the upside, but keep more of what they make and even offset some of their income. Okay. So I want to show you a case study. I bought this deal in December of 2020, 150 units in Fort Worth, Texas. And I bought it for $13 million. I closed December 15th, 2020. This is the deal I was telling Grant Cardone that, I'm going to close it in December and I'm going to get the full value of the bonus depreciation. And he didn't believe me. And so just going through exactly what I taught, 11.44 million was allocated to the building and everything in it. And the rest was allocated to land. So the depreciation only applies to the 11.44 million. So if I had done straight line depreciation, I would get a $416,000 a year loss. When I did the cost segregation and bonus depreciation, my year one loss in 2020 was 4.123 million. Now, this year I had an amazing year. Okay. I sold a bunch of deals. I was going to pay all this capital gains tax. My seminar business was booming. I would do events and literally hundreds of people would sign up for my mentoring programs. So I had all this earned income and I was going to pay a lot of money in tax in 2020. And so what I did is at the end of the year, I found this deal, and rather than syndicate it, I put in about 3 million of my own money, literally. And then I had 3 friends that each wanted to put in 300K. So this was not really a syndication. It was basically 4 of us did a deal together. I put up 81% of the money. Okay. And my 3 friends put up 19% of the money. And so we got a $4.123 million tax deduction for 2020. And I got 81% of that. So I got a tax write-off. I got a depreciation loss of 3.339 million. And each of my friends that invested 300,000, they got a $261,000 tax deduction. So this is what a Schedule K-1 looks like. So, we hire the accountant that does the tax return for the entity. You can see the entity name was BJS, which are my initials, Bradley James Sumrock. Savoy was the name of the property, LLC. And then you can see my personal name and my, part of my social security number. And you can see on the K1, I had a net loss of $3.339 million. And I'm in a 37% tax bracket. So this saved me $1.235 million in tax, meaning if I hadn't bought this deal in December of 2020 and didn't invest the money, I would have had to pay the IRS that money. I would have had to pay them $1.235 million, but instead I put it into a building and then I didn't have to pay that money. So that's a real savings because I would either write the check or I buy the building. Does this make sense? I either write the check to the IRS for $1.2 million or I put $3 million into the deal and then I don't write the check. And now I have the property. So how else did the property do? Well, the first year cash flow was $450,000. I sold it 2.5 years later. I paid $13 million. I sold it for $19.65 through forced appreciation, value add, upgrades, raising rents, raising occupancy, optimizing expenses. Like the down payment was only $4.5 million. When we sold it, we made over $6 million in profit. This is how I have became, part of who I am today, which I'm not bragging about it, but like literally I've made tens of millions over, 24 years, but doing this, buying deals. Okay. And so when I have years where I make a lot of money, from selling my deals, capital gains tax that I would have to pay, if my coaching business is booming, that's all earned income or capital gains income. So rather than, going out and buying Lamborghinis and living this fancy lifestyle, and I've done a little bit of that, but the truth is most of my earnings, I reinvest in buildings and then I don't pay the tax. And then the buildings kick out cash flow and go up in value. So I've been able to build wealth slowly, but intentionally over 24 years. And I've been able to help a lot of other people do it. So I'm finishing up here. And this is where I wanted to leave you with is I help so many people do this. And the biggest question I get is, Brad, could you help me do this too? And look, the answer is yes. And how I help people is just like how I started, I went to a seminar and I I went to a seminar and I hired a mentor. And now I do seminars and I mentor other people. Okay. And I teach a proven system. I teach a 4-step system that anybody can learn if you're committed and pay attention. And I teach how to understand the deal and the numbers, finding the deals, analyzing the deals, funding the deals, raising the money, getting the debt, closing, managing, and exiting profitably. And I teach what I do, and I do what I teach. And I'll say that again. I teach what I do, and I do what I teach. So my next teaching event is coming up now in less than a month. It's going to be at the end of this month in Dallas, and we start the evening of the 26th, which is a Friday. So I have a short session Friday night, and then we do networking. Okay. And so we start around 4 or 5 o'clock Friday evening on June 26th. Then we do networking. And then I teach all day Saturday from 9 to 5 and all day Sunday from 9 to 4. So you could come in Friday morning into Dallas, and then you could leave late Sunday or early Monday. And here's the deal. I used to charge several $100s for this event. Many of you on know that because you've paid to come to this event before. And right now I'm doing it free. And honestly, why am I doing it free? Is that we need more people. We need more people investing in apartments. We have a down cycle. There's a lot of fear out there. There's the Iran war. There's talks of inflation and oil going up. And there's so many investors sitting on the sidelines. But what that creates is a vacuum. There's opportunity to buy deals. And honestly, people were afraid. And so rather than trying to charge money and make money at this event, like I'm doing this event for free. Okay. And so for you to come, all you have to do is you scan that QR code and it's going to bring you to an event page and you're going to see 2 options. Most people take the free option. And some people that want a platinum experience, they buy a $200 ticket or, more exact, $197 ticket. So the $197 ticket, you get better seating, you get lunch with me on Saturday, and I do a bonus training session Sunday morning for about another hour. So everybody Sunday will start at 9, but the VIPs will come at 8. And I'm going to show you how to underwrite or analyze a more complex apartment deal. Okay, so if you really want to enhance your experience, invest $200. But I can tell you, most people do the free one, and the free one's a great value. I mean, it's free, but don't think that because it's free, it's not valuable. I think this event is easily $1,000 event because I teach a lot. It's not a sales pitch. I mean, sure, during the event, I will mention my 1-year programs that you'll have the opportunity to consider signing up for, but you don't have to buy anything. And it's not a pitch fest. It's not a Grant Cardone event. I don't have hundreds of salespeople following you around with sales forms and all that stuff. Like, this is a workshop. Okay, it's an intimate educational event. It's not a multi-speaker event. It's going to be me teaching for 16 hours, and I may have 1 or 2 guest speakers. My friend Robert Helms at the Real Estate Guys, he loves to come. I may have him come. I've asked a few other people to come, but this is not an event where you're going to be teased, by 27 different speakers all coming on stage for 20 minutes. I am going to teach you from A to Z how to buy an apartment building, how to fund it, how to find it, how to analyze it, how to make the offer, how to close it, how to operate it. Okay, so that's what you're going to get. So again, you have the free option, you have the VIP option, and all you got to do is scan there. Okay, so I'll leave you with this comment: is that Warren Buffett once said, when others are greedy, you need to be fearful. But when others are fearful, it's the time to be greedy. And there's so much uncertainty right now. Uncertainty is another word for fear. There's so many people on the sidelines that those that are in the business taking action are getting steals of a deal. I mean, one of my partners, if you own deals right now, it's tough. One of my partners is like, Brad, it's going to get worse before it gets better. Like, prices are going down and but it's a great time to be buying. Like, when prices are going down, it's a great time to be buying. Okay. So I've made a lot of money. Like, the best time that I ever bought was in 2011 and 2012. I made a killing. And this time we're in right now reminds me of that time. Okay. So again, if you take action, I think you're going to be pleased. If you wait, I mean, look, it's never too late to get in the business. I'm never the kind of guy that's going to try to create scarcity. But I'm telling you, for those that get in the business now and learn the business and go through the learning curve and build their teams and get their education going and start looking at deals and maybe even get into a deal in 2026, you're going to be better off than if you waited. And that's not always true. Sometimes it's better to wait, but right now is not that time. So again, I want to invite you as my complimentary guest. Come to Dallas, no matter where you are in the country. Look, and I know most of you are not from Dallas. Yeah, you got to hop on a plane, buy a Southwest airline ticket, get a $99 ticket, stay in any hotel you like. We're doing the event at a conference center, so it's not attached to a hotel. There's a lot of hotels around there. And you'll get the location once you scan and opt in and secure your free seat. So I know I said I'd finish at the top of the hour. I went a little over. It's 9 minutes after the top of the hour. And hey, I just want to leave you with this. Apartment investing has allowed me to quit my job, replace my income, and now by a factor of 10, I live off of my investments. My net worth has gone up to tens and tens of millions of dollars, and I keep most of what I earn. Okay, I haven't paid tax in 6 out of the last 8 years. And that is available to anybody. I'm not saying you're going to do exactly what I did in 2 weeks. This is not a get rich quick type of thing. But if you get into the business and stay in it, many of the people that I've coached have quit their jobs. They replaced their job income with their investment income. So they get the cash flow, their net worth has gone up, and they also keep more of what they earn. And so this is why I love apartments, ladies and gentlemen. We get paid more than one way. We get paid while we own the property through cash flow from operations. We get paid, if we do a good job and the market doesn't screw us, we get paid because we sell more than we buy. And I've been doing this 24 years, and the values of the deals generally go up, and sometimes there's cycles, And so, yeah. I'm going to do trainings later in the year. Some of you are asking about that, but I don't have those dates set yet. So you stay in my email list. If you're on here tonight or listening to the recording, you're already in my database. I'll send you updates when I'm doing trainings. I do a bunch of these free trainings, 1 or 2 every month. I try to pick a different topic that's interesting to you and passionate for me. And I do an in-person event, every 3 or 4 months. So my next one won't be until like Q3 or the fall. Okay. So I would say if you could rearrange your life to be at this event in Dallas at the end of June, it'll be worth your time. I promise. Okay. So let me ask you this before we go. Who on here right now is coming to Dallas event? Just type the name of the event is Rat Race to Retirement, R2R. Type in R2R if you're coming to the event. I know Calvinita, you are. Anyone else coming? Anyone else sign up? Let's see. Who's coming to Dallas? Okay, Win, got you. Anybody else? Okay, Joyce, amazing. Okay, great. I see a lot of you are coming. So Dawn, Dave, that's Lawrence, amazing. Okay, you guys aren't going to regret it. You guys are going to love it. And we're past the hour, and I love to honor my commitments. So I'm going to say good evening. I'm not going to say goodbye. I'm going to say see you soon and see you at the end of June for many of you. Okay, thank you and good night.